Stephen, I want to have a look at credit in this part of the world and get your views on particularly Chinese credit and some of these bondholders really at the moment in trouble. Some of these companies which have been issuing debt in China. How have you been looking at it?
In China, we have seen the economy in terms of the normalization and recovery to be surprisingly rapid and almost anticlimactic. So the policymakers now can afford to be more patient, and so from our standpoint, that gives them, kind of more room to ease if there are hiccups, in the future. So to us, that's actually not a bad place to be. On China, local currency bonds, it might even offer some safe haven characteristics and could provide a good hedge, along with index inclusion and weight increases, along the way. On credit, in even U.S. dollar Chinese names, we think the underlying growth will also provide a positive backdrop, but we'll be focusing a little bit more on the domestic sectors. We have been hearing a lot more about this dual circulation framework that the top policymakers in China is making, putting even more emphasis on the rebalancing towards a consumption economy. And so the domestic sector to us could do quite well ahead.
Stephen, with all these central banks pumping liquidity into the economic system, it must have distorted all these credit markets. So the thing is, when we get to some sort of normality, do we get a situation akin to finding out who was naked when the tide goes out?
So this is, kind of a million-dollar question. I think when you look at the central bank, expectation on future rates, we are not expecting, any move in particular. The most important one, with the Fed. So it will still be a while along the way. We think there will be some areas that would show cracks. But since March, the general liquidity situation is very ample, and we think the kind of number of accidents will be relatively manageable.
And Stephen, you've said now that the dollar decline has just started, but it hasn't exactly benefited all EMs at this point. What sort of case are you building now, and what sort of EM economies can actually benefit from it?
So I think all in, U.S. dollar, in terms of the yield advantage versus both other developed markets such as the euro and the yen, that interest rate gap has shrunk to almost nothing. So that reduces the support of U.S. dollar, and to us, the U.S. dollar on a longer-term valuation is, also expensive. The U.S. dollar also would have benefited more from a safe haven type bid if investor wanted to flock to treasuries, but treasuries now with yield so low, that also reduces that attraction. So it's there will be more impact, kind of looking at different countries, how they're doing on the public health situation, how they have, seen the economy recover. So for selective, Asian currencies, we do think there will be some strength ahead, such as in the renminbi and maybe the Korean won. But there are other markets which have more vulnerability, both in terms of their, kind of macro imbalances to, how they are dealing with this COVID-19 situation. So there will be quite an uneven type of, kind of dollar and FX trends for them.